Here's a number that should bother you. The average American retires with less than $50,000 in savings. That's it. After 40 years of working. After decades of paychecks. And the worst part? It's not because they didn't earn enough. It's because nobody ever taught them what to do with what they earned. If you're watching this right now, you're already ahead. Because in the next 12 minutes, I'm going to walk you through everything, from what investing actually is, to how to make your first investment today, even if you're starting with just $100. No jargon, no complicated math. Just a clear step-by-step guide that I wish someone had given me at the beginning. Here's exactly what we're covering. We're going to talk about why most people stay broke even with a good income. Then I'll break down every type of investment account, Roth IRA, 401k, brokerage in plain English. We'll cover what to actually put your money into, how much you need to start, and I'll walk you through your very first investment, step by step, live on screen. By the end of this video, you will have a complete roadmap. Let's get into it. Why most Americans never build wealth. Let me tell you something that sounds simple, but most people completely miss. There are 2 ways to make money. The first is trading your time for it. You work, you get paid. The second is making your money work for you while you sleep. That second way is called investing. The problem is that the American education system never taught investing. Not in high school, not in most colleges. You graduated knowing how to write an essay about Shakespeare, but nobody explained compound interest. And compound interest is, without exaggeration, the most powerful financial force in existence. Albert Einstein reportedly called it the 8th wonder of the world. And here's why. If you invest just $200 a month starting at age 25, and you earn an average return of 8% per year, which is historically what the U.S. stock market has averaged, by the time you're 65, you'll have over $700,000. That same $200 a month, stuffed in a savings account. The difference is $580,000, and you didn't do anything differently. That's what this video is about. What is investing and why it matters? So what actually is investing? At its most basic, investing means putting your money into something with the expectation that it will grow over time. When you buy a stock, you're buying a tiny piece of a real company. If Apple does well, your Apple stock goes up. If it does poorly, it goes down. That's it. When you buy a bond, you're lending money to a company or the government, and they pay you back with interest. When you buy an index fund, which is what I'm going to recommend for most beginners, you're buying a tiny slice of hundreds of companies all at once. Instead of betting on one horse, you own a piece of the whole race. Now here's the thing about risk that nobody explains clearly. Yes, investments go up and down. In 2020, the market dropped 34% in 1 month. Scary, right? But by the end of 2020, it had completely recovered and hit new highs. Historically, the U.S. stock market has never had a 20-year period where it lost money. Not once. Through wars, recessions, pandemics, over any 20-year stretch, it's always been higher at the end than the beginning. So the risk of investing is actually this: picking the wrong thing or panicking and pulling your money out at the wrong time. Stay diversified, stay patient, and time is your biggest asset. Types of investment accounts in the USA. Okay? This is where most beginners get confused, and it's really important to get right. Because before you invest in anything, you need to understand where you're investing. The account type matters as much as what's inside it. Let's go through each one. First, the 401k. If your employer offers a 401k, this is your first stop, especially if they offer a match. A 401k is a retirement account where you contribute money from your paycheck before it's taxed. That means a $100 contribution actually only costs you around $78 out of pocket if you're in the 22% tax bracket. And if your employer matches, say they match 50% of your contributions up to 6% of your salary, that's free money. Free. Do not leave it on the table. The 2025 contribution limit for a 401k is $23,000 for most people starting out. A Roth IRA is second, are completely taxed now. Meaning you pay tax now, but all your gross to $60,000 over 30 years, you pay 0% tax on that $54,000 per month, or $561,000 a single filer is a single filer, a regular brokerage account, but no limits either. You can put in as much as you want, withdraw whenever you want, no penalties. This is for money beyond your IRA and 401k contributions. So what's the order? Step 1, contribute enough to your 401k to get the full employer match. Step 2, max out your Roth IRA. Step 3, go back and contribute more to your 401k. Step 4, open a brokerage account for anything beyond that. Follow that order and you're ahead of 90% of Americans. Real quick, if this is helpful so far, hit subscribe. We put out regular videos like this, breaking down personal finance in plain English. No fluff, no sponsored garbage, just the stuff that actually works. Okay, let's keep going. What to actually invest in. Alright, you know what accounts to use. Now what do you put inside them? For most beginners, the answer is simple: index funds. Specifically, a total market index fund or an S&P 500 index fund. Here's what that means in plain English. The S&P 500 is a list of the 500 largest public companies in America: Apple, Microsoft, Amazon, Tesla, Johnson & Johnson, and 495 others. Lets you own a tiny piece of all 500 of them, automatically, for an extremely low fee. The most popular ones are Vanguard S&P 500 ETF, SPY, SPDR S&P 500 ETF, FXAX, Fidelity 500 Index Fund. These are essentially the same thing. They track the same index. They've all averaged around 10% annually over the long term. Now here's why index funds beat most professionals. Study after study has shown that over a 15-year period, more than 90% of actively managed funds, the ones with hotshot fund managers picking stocks, underperform the S&P 500. The guys with Bloomberg terminals and Ivy League degrees can't consistently beat it. So instead of trying to outsmart the market, you just own the market. That's the strategy. What about individual stocks? I'm not going to tell you to never buy individual stocks. But if you're a beginner, put your first $10,000 to $20,000 into Index first. You can use 5 to 10% of your portfolio for individual stock picks if you enjoy it. Just treat it like entertainment money, not your retirement plan. What about crypto? Crypto is extremely high risk. If you want exposure, keep it under 5% of your portfolio. Bitcoin has had multiple 80% drawdowns. Some people got rich. Many more lost everything. I won't tell you to avoid it. Bet your future on it. Bonds? When you're young, under 40, most advisors recommend keeping the majority of your portfolio in stocks. Bonds are for stability as you get closer to retirement. A simple rule: your bond percentage equals your age. At 25, hold 25% bonds. At 60, hold 60%. This is the question I get more than any other. And the answer might surprise you. You need $1. Literally $1. Fidelity and Charles Schwab both have zero minimum accounts. You can buy a fractional share of a VU ETF for $1. The barrier to entry is gone. Now, will $1 make you rich? Obviously not. But the goal of starting small is to build the habit, because the most dangerous thing in personal finance isn't investing poorly, it's not investing at all. Here's how I'd think about it at different income levels. If you make $40,000 a year, try to invest 10%, that's about $333 a month. Even $133 in 30 years at historical returns. If you make $60,000 or more, push for 15 to 20%. The earlier and more aggressively you save, the less time you have to work. The single most powerful variable in wealth building isn't how much you earn. It's how early you start. Someone who invests $200 a month from age 22 to 32, just 10 years, and then stops entirely, will end up with more money at 65 than someone who invests $200 a month from age 32 to 65. 33 years of investing, and never stops. That's the math of compound interest. 10 years versus 33 years, and the early starter wins. Start today, not next month. Today. Step by step, making your first investment. Alright, let's actually do this. I'm going to walk you through opening your first investment account and making your first purchase. We're using Fidelity, it's free, trusted, and has no account minimums. Step 1, go to fidelity.com and click Open an Account. You'll choose between account types. For most beginners, start with a Roth IRA. If you don't have earned income or are over the income limit, open a standard brokerage account instead. Step 2, fill in your personal information. They need your social security number, address, employment information. This is standard. It's required by law. Fidelity is one of the most trusted financial institutions in the world. Step 3, link your bank account. Connect your checking account. You can start a transfer immediately or set up recurring automatic investments, which I strongly recommend. Set it and forget it. Even $50 or $100 a month, automatically transferred on the first, builds massive wealth over time without you thinking about it. Step 4, once funded, search for your investment. Type in FXAEX, that's Fidelity's own SNX fund. It has a 0.015% expense ratio. You pay $150 in fees per year. Step 5, click buy, enter your amount, confirm. You're an investor. That's it. You just did what most Americans never do. Going forward, set up automatic contributions. Log in once a quarter to confirm everything looks right. And then, this is important, leave it alone. Don't watch it daily, don't panic when it dips. Let time do its work. Common beginner mistakes to avoid. Before we wrap up, I want to talk about the mistakes that cost beginners the most money. Because knowing what not to do is just as important as knowing what to do. Mistake first, waiting for the right time to invest. There is no right time. People have been saying the market is too high since 1950. Time in the market always beats timing the market. Start now with whatever you have. Mistake second, checking your portfolio every day. The market fluctuates constantly. If you're investing for 30 years, a bad week means nothing. Checking daily causes emotional decisions. Set a reminder to review quarterly. That's it. Mistake third, investing before you have an emergency fund. Before you put $1 in the market, make sure you have 3 to 6 months of living expenses in a high-yield savings account. Because if your car breaks down or you lose your job, you don't want to be forced to sell investments at a loss to cover it. Mistake fourth, chasing hot stocks or trends. By the time something is trending on social media, the smart money has already moved. Meme stocks, crypto hype cycles, the next big thing. Most retail investors who chase these lose money. Boring index funds consistently win over the long run. Mistake fifth, ignoring fees. A 1% annual fee sounds tiny, but over 30 years on a $100,000 portfolio, that 1% fee costs you over $100,000 in lost growth. Always check the expense ratio before investing in any fund. Target 0.2% or lower. Index funds are almost always under 0.1%. Let's bring this all together with a simple action plan. Here's exactly what to do after you close this video. 1. If your employer offers a 401k match, increase your contributions to capture the full match this week. Log into your HR portal today. 2. Open a Roth IRA at Fidelity or Schwab. Takes 10 minutes. Fund it with whatever you can, even $50. 3. Set up automatic monthly contributions. Even $100 a month. Make it automatic so you don't have to think about it. 4. Invest in a simple S&P 500 index fund, FXAEX at Fidelity, VU at Schwab or Vanguard. 5. Build your emergency fund in a high-yield savings account before investing more aggressively. That's your entire beginner's plan. 5 steps. Nothing complicated. The people who build real wealth aren't smarter than you. They're just consistent. They started, they automated it, and they didn't panic. Now you have the same playbook. If this video helped you, please subscribe. We put out a new personal finance video every week. And leave a comment. What's the first thing holding you back from investing? I read every comment, and I'll answer yours. I'll see you in the next one.